Right. In this class, we're going to pick up from where we finished our last class, the class before spring break. Remember in that class we were talking about the challenges of diversification as a risk mitigation tool, relying on correlations to reduce risk, assuming that low correlated assets provide diversification. It's probably the most used mitigation tool in finance, but as we saw, correlations are incredibly unstable over time. And so we're looking at an alternative. I showed you in class how Bridgewater looks at it, looking at different environments. And then we have this presentation was made at a CFA luncheon, and it also goes into different environments, but he has it fairly simply broken up. The one thing he looks at is growth. Is the economy growing, or is it accelerating or decelerating? The second thing he looks at is inflation and gold prices. So where he's setting up here is how correlated are these asset classes in these environments. So if the economy is accelerating, and what he's using to measure how economy is accelerating, here he's looking at GDP growth. You're going to see in a future chart he actually measure this. The way he says is the easiest way to measure it is look at corporate bond spreads. If corporate bond spreads are narrowing, then the economy must be doing well, in which case it's a strong economy, it's accelerating growth economy. And then he looked at decelerating economy, and a decelerating economy, what he says is the economy shrinking, or his other alternative measure, which is his primary measure for this, is our spreads, corporate spreads widening. Our bond holders of corporate bonds getting worried about economic growth. And so you can see when the economy is strong, obviously stocks do well. Bonds, we're going to talk a little bit about what he means by bonds here. He's actually talking about treasuries, but treasury bonds do very poorly. Gold does badly in this environment, but commodities do well. Steel and concrete and silver and other metals, commodities do well in this environment because they're input to the economy. And so when the economy is strong, the producers of commodities sell more. When the economy is decelerating, obviously stocks do poorly, treasury bonds do very, very well. Gold prices do well because gold is the place you go when the U.S. economy is doing poorly. And then commodities do badly because they're, again, input, the raw materials into the economy. So when the economy is slowing down, they will do badly. And you can see here is in this scenario with growth, economic growth is the focus. Stocks and bonds are negatively correlated. Stocks and gold are negatively correlated. Stocks and commodities are positively correlated. Now let's go to his other scenario, which is related to inflation. And here for inflation, he is actually measuring inflation here, but his actual measure of inflation is gold prices. So if gold prices are rising, that must be in a period when inflation is rising. If gold prices are falling, that must be a period where inflation is falling. When inflation is taking off, stocks and bonds both do badly, and gold and commodities do well. He's using actual asset returns to measure this. When inflation is decelerating, we have low inflation, similar to the period we have right now. Stocks and bonds are, again, positively correlated. They both do well. And gold and commodities are positively correlated. They both do poorly. So there are scenarios where stocks and bonds are negatively correlated and they help diversification. There are periods when stocks and bonds are positively correlated and they don't help diversification. There are times when stocks and gold are negatively correlated, and there's times when stocks and gold is negatively correlated. So you can see stocks and gold are almost always negatively correlated in both cases. And I remember at USAA, the gold manager, the manager of USA's gold fund would come over to me. He was trying to project whether or not we should be over-allocated or under-allocated to gold. And one of the questions he would ask me is, what is your outlook for the stock market? If I had a strong outlook for the stock market, they gave him a weak outlook for gold. So he also agreed with this, not that he looked at this study, that was just one of his inputs. So, and then you look at commodities and stocks. Here you can see in an accelerating economy, they're positively correlated, decelerating. So when economic growth is the issue, stocks and commodities are positively correlated. And when inflation is the issue, stocks and commodities are negatively correlated, as they are with bonds. So a good way to look at this is, I like this next chart where he's looking at assets outside of the U.S. So he's looking at Germany and looking at, for German investors, German stocks would be their domestic equities. What he wanted to ask was, is this true outside of the U.S.? And you see the exact same thing. Stocks have a negative correlation to the price of gold. So when gold's rising, stocks are usually falling. Stocks have a negative correlation to corporate bond spreads. When corporate bond spreads are widening, that means you have a weak economy. Stocks do badly. For bonds, when gold prices are rising, that's inflationary. Bonds do badly. When spreads are widening, treasuries do well because it's a weak economy. For gold, obviously, if gold prices are rising, gold will do well. And when spreads are widening, where you have a weak economy, gold does well. And then on commodities, when gold prices are rising, that's inflation. Commodities do well. When spreads are widening, that's a weak economy. Commodities do poorly. So essentially, they're saying you cannot talk about the correlation of asset classes between each other without asking what's driving markets. Is inflation driving the markets? Or is economic growth driving markets? Right now, the market is very much focused on economic growth, and therefore stocks and bonds have been negatively correlated. Treasury bonds are up tremendously the last few weeks, whereas stocks are down tremendously the last few weeks. If we go into an inflationary scare, stocks and bonds will both fall dramatically, and that's when you're going to wish you had some gold in your portfolio. Gold has actually been doing well recently because of the crisis. So, and commodities obviously have been doing really badly in this crisis because obviously commodity prices are falling because the economies are falling. So, I think it's a really good way of thinking about risk and thinking about correlations and how to diversify your portfolio. So before we get into these alternative approaches, I want to show you a video by the writer, of the gentleman who wrote the book Random Walk Down Wall Street. And he's going to talk about this diversification issue as well. And there's 3 things that he says. It's just 5 minutes of this video. I'm not going to show you the whole thing. So Burton Malkiel, I want to let you hear what he has to say about diversification. Who am I to disagree with Burton Malkiel? But I do want, there's 3 things I want you to hear that he says. Hopefully you'll pick up on them as he goes. So listen to him carefully and see if you pick up on the same 3 things I picked up on. Oh, sorry. Okay, so let's think about what he has said here. Very, very interesting discussion. There's 3 things, maybe 4 things we can get out of this. So let's think about this. So Burton Malkiel, very famous, obviously very well known in finance, very highly respected in finance. Oops, sorry, I didn't mean to start that again. Let me. All right, so. Right, so very interesting discussion. Let's think about what Burton Malkiel said. He's obviously very famous, highly respected in finance. So so what does he have to say about diversification? Let's start with one of the first things he said is he talks about bonds and stocks are now negatively correlated. So they provide great diversification. Well, we just talked about that, didn't we? Why are stocks and bonds negatively correlated now? Well, it's because the markets are not focused on inflation. The chart he showed that back in the 70s and 80s, stocks and bonds were positively correlated. Why? Because everybody was focused on inflation. So of course, stocks and bonds are negatively correlated now. We're in that environment when they are negatively correlated. So that exactly fits with the discussion we have. Stocks and bonds are a great diversifier unless inflation becomes an issue. Is that a good way to diversify a portfolio? Wow, this diversification is great. Well, unless this risk materializes. The second thing I want to address, which I think is one of the ways finance is somewhat deceptive, and that is what he calls bonds. It is true in 2008, Treasury bonds were a great place to be. They really diversified portfolios. However, very few investors actually put most of their bond money into Treasuries. Most investors allocate most of their bond money to corporates because corporates materially outperform Treasuries over time. If you looked at corporates in the 2008 crisis, they were down dramatically, some as much as 15-20%, even for very good investment grade securities. So you need to distinguish, are we talking about treasuries or corporates? Corporates are much more highly correlated to stocks in any environment, whether it's inflation or growth-related scenarios. So I think it's really tricky to me that people in finance talk about, well, stocks and bonds are great diversifiers, but they don't mention which bonds they're talking about. It's extremely important you distinguish between treasuries and corporates. The next thing he talked about, emerging markets. He said, sure, correlations are higher, but the ending return was much higher. Whether he's talking about versus developed markets are stock markets of countries like the UK and France and Japan. Those developed countries other than the United States, or if even comparing the US market. He said if you look at the last decade, emerging market stocks were up 10%. Well, that's true for that period of time. And I don't know if you noticed in that slide, he was recommending a 34% allocation to emerging market stocks and developed market stocks. So 1/3 of your stock portfolio to non-US stocks. And he said, hey, look, in that 10-year period, that last decade from 2000 to 2010, good thing you had money in emerging market stocks because US stocks and developed market stocks didn't do anything. Well, that's great for that decade. But if you had done that the last 10 years, from 2010 to 2020, U.S. stocks materially outperform international stocks by so much that 34% allocation to emerging market and developed market stocks would have really greatly diminished the return on your portfolio. So again, this was extremely time dependent. he made an argument that worked really well for the particular time he was discussing, but 10 years later, his entire argument falls apart because the allocation he's recommending actually would have done tremendous damage to the return of your portfolio and would not have reduced your risk much because the markets were still highly correlated. Now, the last thing he said, which I agree with him, and that we've seen in our alternative approaches, is that gold is a great diversifier. And that is absolutely true. We've seen that. We saw that in both the Bridgewater discussion and in the CFA discussion. So I agree with him on that. And why is that? Well, because gold does badly during growth environments, and gold does badly when inflation is not an issue. So gold is that one issue that when stocks and bonds are positively correlated, gold will be that one negatively correlated asset that will help you tremendously. Same thing with commodities. He didn't mention commodities. But commodities is the one thing when stocks and bonds are positively correlated because people are worried about inflation, commodities are a place to help you diversify. So while with due respect to one of the great minds of finance, arguing against my argument on diversification, him arguing that it still works, I actually, and unfortunately we're videoing this class, so it'd be out there for all people to watch. I actually disagree with him on his point and think actually everything he said, our discussion actually provides a strong argument against what he said, and actually his arguments, I think if you look at them in the context of what we talked about with environments and diversification, his arguments are actually strongly support the case we just made. So what we'll do next is we're going to talk about one-third approach, which is use of options. And so we'll do that in our next session.